Welcome to The Call, an exclusive conversation hosted by the Chamber's Global Intelligence Desk. We're delighted you are able to join us. Please note the views of our guests today are not necessarily those of the Chamber, but we hope you will find those views as valuable as we do. Let's get started. Good morning, and welcome to The Call, brought to you by the U.S. Chamber of Commerce here in Washington. I'm your host, Jay Sapsford, and here's today's question of the moment. How will trade tensions impact the global economy? On Wednesday, President Trump put out a 90-day pause on the reciprocal tariffs announced last week. The U.S. stock market rebounded on the news, but the trade tensions are not over. During the pause, imports from most countries will now face an across-the-board 10% levy. Meanwhile, global steel and auto tariffs remain in place, and the president singled out Beijing, saying Chinese imports will face tariffs of 125%. As you can see, the rapid changes of recent days sparked a jump in uncertainty over trade policy. That uncertainty is causing many economists to reassess growth forecasts. The shifting environment also raises questions over inflationary pressures and interest rates. Joining us now to address these questions is one of the most trusted voices in global macroeconomics, Mark Zandi, Chief Economist at Moody's Analytics. Mark, welcome to The Call.
Jay, it's so good to be with you. Thanks for the opportunity to talk to the group.
Now, I would want to start by noting that the job of the economist right now in forecasting the outlook must be very difficult with the inputs changing almost on a daily basis. I wonder what your latest forecasts are, given all of the developments on the trade front.
Well, I think a recession, a global recession, a U.S. recession is more likely than not this year. Despite the president's reversal on reciprocal tariffs yesterday, he raised tariffs on China. We're at 125%. We're 10% across other countries, 25% on auto, steel, and aluminum. It feels like we might get more tariffs on other products here pretty soon. Kind of do the arithmetic, the overall effective tariff rate across all countries, all products, still over 20%. Really didn't change all that much with the decision to backtrack on the reciprocal tariffs. 20% is very high. It's going to be very disruptive and obviously, highly disruptive with regard to the trade with China. And that's a massive relationship. The trade between the two countries is about $600 billion a year. That feels like that could all but shut down. So, given that and all the uncertainty and everything else, I think recession risks are high. I'll end by saying, just to summarize it, because I think to let people know kind of how economists are thinking about this, they attach a probability of recession as kind of the metric to gauge, how worried they are about what's going on. I'd put that probability at about 60%. So there's still 40%. We can still find our way through this, but it's the probability of recession is now very, very high, uncomfortably high, and moving in the wrong direction.
Yeah, I noticed that the president, of course, really singled out China for really steep tariffs. But at the same time, in the stock market, a lot of the companies that have exposure through their supply chains to China actually rose yesterday. Was that just an uplift on the total market, or is that expectations that some sort of a deal is going to be cut with China?
Probably all of the above. I don't know that I'd put too much weight on market action in a given day. It's going up, going down, going all around. Clearly very tied into what their investors are hearing about the trade war and how that's playing out. But I'm not sure I would read too much into that. I suspect investors are hoping beyond hope that the president can figure out a way to take an off-ramp here, even with China. I'm not sure exactly what that off-ramp looks like, but I think they're hoping for that. I would say I think they're probably overly optimistic. It just feels like to me both the president and Chinese leadership are dug in here, and it's going to take a lot to get off this out of this trade war. And it also feels like the president is going to go forward with higher tariffs one way or the other. They're part of the landscape going forward, and that's going to be an adjustment. So. I don't know that I take too much solace in the market action yesterday.
Mark, I wonder if you might be able to tell us if the tariff rates went in as they are currently set at 125%, who would suffer more, China or the United States?
Great question. I mean, I think the intuition is, and I think it's the administration's view that China would suffer more. I mean, kind of the straight up explanation as well. I mentioned 600 billion in trade. 450 billion of that is Chinese imports into the United States. 150 billion is U.S. exports to China. So, if trade breaks down, it feels like that should do more damage to the Chinese economy than it does to the U.S. economy. Uh, but I'm not so sure. The fact that that the trade is collapsing with China, and if the trade deficit goes to zero, that means the Chinese won't have the dollars to reinvest back into the United States. As you know, Chinese have been major investors. They trade with us. They have a trade surplus with us. They get dollars. Those dollars come back in the form of investments. And one of the places where they invest is U.S. Treasuries. Not long ago, a few years ago, before the first trade war under President Trump, they were the largest holders of U.S. Treasuries, well over $1 trillion in holdings. That's come down since then, but they're still the second largest holder. And so if they have less dollars, that means less Treasury purchases. Their portfolio runs off. That means higher interest rates. And we're getting a sense of that. You can, in the bond market in the last few days, that perhaps that's playing a role here. So the other thing is that I point out is, the Chinese have a lot of kind of potential for economic policy support. The PBOC will cut interest rates, reserve requirements, do what they need to support the economy. The Chinese government, has a lot of firepower that they're able and willing to use to help support their economy, the stimulus. Here in the U.S., I don't know that we can count on the Federal Reserve to cut interest rates to come to the rescue, at least not quickly, because they're very concerned about the tariffs and what it means for inflation and inflation expectations. And of course, Congress and lawmakers are tied down by this effort to get the reconciliation package through. And given the DOGE cuts to jobs and government funding, it's hard to imagine that they're going to come with any stimulus. So I can go on, but I'm not so sure this narrative that the Chinese are more vulnerable than we are in this trade war is correct. It feels like we're both at significant risk.
Well, one of the things that you suggest here is that the U.S. is more vulnerable to financial market disruptions than China is. And what if you might be able to drill down a little bit on the dynamics there?
Yeah, sure. In a number of ways. I mean, the most obvious is the stock market, right? It feels to me like the stock market is central to the U.S. economy. We're all focused on it. 60%, 65% of Americans own stocks. The well-to-do, the folks in the top part of the income and wealth distribution, they are key to consumer spending. They drive the kind of the spending and the growth. I mean, just to give you a statistic, this is my calculation, the folks in the top 10% of the income distribution here in the U.S. account for 50% of spending. So those folks are really looking at their portfolios, their stock portfolios very carefully, and they see a lot of red and declining stock prices and wealth. You get these negative wealth effects, and it will really hurt the U.S. economy as they grow more cautious. Stocks in China, not so central, much smaller piece of the economic pie. And of course, the Chinese government has shown in the past that they're willing to step in and shore up that market if it starts to go south. And of course, as I mentioned, the bond market, this is where I get most nervous. And it's not just about the Chinese, it's about global investors writ large. I think there's reason to be nervous that global investors are questioning the safe haven status of U.S. Treasury bonds. Historically, since Alexander Hamilton, bought back the Revolutionary War debt on pennies on the dollar, we were considered to be money good, AAA, the best credit on the planet. So if there's a crisis anywhere on the planet, including here in the United States, money comes flowing into the United States at a time when it's very important and very helpful to the economy. If we lose that safe haven status, we lose that. And it does feel like, I don't want to push this too hard. We need to see how this plays out. But I'm just getting the sense that global investors are questioning, whether or not if they put their money here, it is money good and it is safe, and with good reason. I mean, they're hearing from administration officials about, is the reserve currency status of the United States something we really want? We want a weaker dollar. Do we want a healthy dollar, a strong dollar? Do we want that reserve currency status? So when you hear government officials talking that way, as a foreign investor, you're starting to question, well, maybe my money isn't quite as safe as I thought it was. And if it's not, of course, that has all kinds of very negative economic consequences for the United States in the long run.
Well, it's interesting to note that the president yesterday specifically mentioned the bond market as one of the reasons why he decided to introduce this 90-day pause. Is this a sign to you that that's an ultimate check on the administration's decision making here?
Well, I don't know if there's anything that I would call an ultimate check. I'm not so sure. But yeah, I sense that the reason why the president reversed himself on the reciprocal tariffs yesterday was he was watching the market reaction. I mean, I remember, it's so hard to remember because things are moving so fast, but I think before markets opened yesterday in the United States, we were in bear market territory on stocks. So there was a lot of red on the screen in the futures market, and bond yields were jumping. I think if you go back on last Friday, the 10-year Treasury yield was what, 4%, maybe a little south of 4. We had gotten to 4.5%, and that's very counterintuitive in the context of all the turmoil in financial markets. Again, if you have crises, money comes flowing here, and bond yields tend to fall, and they were rising.
Right.
So you add those two things up, and you go, oh, something feels like it's going to really go off the rails here, and something might break in the financial system. You got kind of a UK Liz Truss kind of moment where something in the system that we don't know about gets stressed by what's going on that's completely unexpected, and it breaks. And so I think that probably did light a fire under officials and the president, and thus the reversal.
What benefits are there to both U.S. consumers and businesses for having the dollar and treasuries as a safe haven investment?
Oh, well, it means lower interest rates, most fundamentally, especially in times of stress and crises. And, when in your risk-off environment, when people are panicked, in much of the rest of the world, interest rates jump. Emerging market debt spreads, spreads in Europe and other parts of the world, they rise. Interest rates rise. The cost of capital rises. But here in the U.S., it comes back in. The rates stay low, come down, and we are even in more typical times, rates are lower than they otherwise would have been because there's this inherent underlying demand for the U.S. Treasury bonds and securities. So it keeps interest rates very, very low. And of course, a strong dollar, healthy dollar helps keep prices down for American consumers. It allows them to enjoy goods more cheaply and more affordably. And you don't want too strong a dollar because, of course, that becomes a problem for manufacturers and producers and exporters. But a healthy dollar that's consistent with a healthy economy is exactly what you want.
Okay, we have an audience member question. Mr. Zandi, thank you for joining us. As an economist, can you think of an instance in which tariffs actually worked, and what were the characteristics of that success?
No, I can't think of a single case. I mean, just go back to the most recent case study that's under President Trump's first term. Obviously a smaller version of what's going on now. That involved tariffs on as much as $400 billion worth of imported product, mostly from China. And just go take a look at the research that's been done to assess the fallout from that episode. And it's pretty clear there was no winners in all that. There are nothing but losers. I mean, just go take a look at the data. Go take a look at manufacturing production or manufacturing employment. It was falling in 2019. Of course, that trade war began in 2018. Really was in full swing by 2018, coming into 19. And if you look at the data in 19, manufacturing was, I'd say, in recession. Farmers, agriculture in recession. You remember the president had to cut checks to the farmers to compensate for the lost exports to China because of their retaliation. The other research shows that there's significant pass-through of the tariffs to importers and consumers. So at the end of the day, 100% of the tariffs were passed through. And here's the thing that I find most fascinating. Great study just came out from New York, I think it was the New York Fed, from the Federal Reserve System, examining the tariffs on steel and aluminum back in that first trade war, and found that those industries' productivity is now 10 to 15% lower because of those tariffs. It reduced competition. The lack of competition means less investment and ultimately less innovation and productivity growth. And so these industries became actually less competitive. So in my view, that's a great case study. Go take a look at the research. It shows that there are no winners. Everyone is a loser. It's just a matter of time when that's the case. I'll just end the response to that question by saying, go back to any other major episode with tariffs. Smoot-Hawley, 1930. That certainly didn't work out very well. I mean, the Great Depression of the 30s had many reasons for them. Certainly, that trade action, that trade legislation was a big part of it. By the way, just as a sidebar, the effective tariff rate in Smoot-Hawley peaked at 20%, precisely where it is today.
Right.
And then you can go all the way back. It feels like every 100 years we kind of go down this crazy path. Go back to, I think it was in 1928, the Tariff Act of 1928 under Jackson. That was a disaster, It takes about 100 years for everyone to die from the previous episode and forget about, how bad an idea this is. But here we are, 100 years after Smoot-Hawley, and we're making the same crazy mistake.
Well, I've noticed that the administration is touting the number of countries, dozens of countries that have reached out and said that they'd like to do some sort of negotiation to a deal. I know the Japanese have cumulative investments in FDI of $750 billion, and they're talking about raising that to $1 trillion, for example. Isn't that a sign of at least some success here for these tariff policies?
Okay. Let's just see how this ultimately plays out. Go back to Trump 1. Could look at the trade deal that he struck with China to end that trade war, or at least to wind it down. Nothing came out of that of any consequences, as far as I can tell. So yeah, maybe there's when you're dealing with 70 countries, you might get something out of some of those deals. I don't know, but I wouldn't count on anything that's going to move the dial to any significant degree. I'm very, very skeptical that that'll be the case. And then at the end of the day, to what end exactly? I mean, what are we trying to accomplish here? What's the objective? I can't even figure that out. Is it reducing the trade deficit? Really? Is that what it's all about? That's not going to work. Is it about attracting foreign investment into the United States in any meaningful degree? The reshoring? Really? Does anyone think that a CEO of a major global manufacturing firm is going to locate here based on these tariffs? Because is that these tariffs going to be here 90 days from now? Or are they going to be here 3 years from now when that factory I'm supposed to invest in is going to come to fruition? What about 10 years from now? These are things done under executive order. They can be changed with the stroke of a pen. It's not in legislation. So I don't get it. What is the objective here? In this kind of negotiating with individual countries over this, that, and the other thing? I don't know that it moves the dial on anything. It's not going to bring U.S. manufacturing back to the United States in any meaningful degree. It's not going to certainly not bring jobs back. I mean, manufacturing only accounts for 8% of the job base already. We're talking thousands of jobs, maybe not tens of thousands of jobs, not even 100,000 of jobs, certainly not millions of jobs. So I'm confused by, you get some Pyrrhic victory over some small economy. Yeah, maybe. I don't know. We'll see. But to what end? To what end?
I'll squeeze in one last audience member question here. What is the significance of the reciprocal tariffs on Canada and Mexico? As you know, that they had a bit of a reprieve up until the pause, because the relationship was anything that was compliant with USMCA was going to remain under that treaty. But now it looks like that 10% floor is going to apply to Canada and Mexico as well. I wonder what.
Jay, I don't know about that. I don't think that's the case.
Oh, really?
I believe the reporting I saw from the New York Times yesterday, and here this highlights another really important point.
Right.
We have no idea. No one has any idea what's going on here. We can't even figure it out. And these are big things. These really matter. We can't figure out. So companies are looking at this and go, what do I do with this? What in the world do I do with these tariffs? No one can figure it out. I think actually the nothing changed for Canada and Mexico with yesterday's decision. So you drop the reciprocal tariffs, 10% for every country. Canada and Mexico, nothing changed. It remained what it was before, I believe. But correct me if I'm wrong. So I think with regard to Canada and Mexico, that probably waits to the refresh of USMCA that'll occur in 2026. We'll see how that plays out. But just go figure. I mean, we can't figure it out. We don't know what it is. How can that be good for the global economy?
Well, perhaps I stand corrected, but to your point, I just wonder, as a final question for you, what is the impact of all of this uncertainty on growth?
It's a tax. It's a tax on growth. I mean, so far, it hasn't resulted in businesses and consumers cutting and pulling back. That hasn't happened. It's not like we're seeing layoffs yet. We're not seeing consumers run for the bunker and stop spending. But what we have seen is everyone now sitting on their hands, frozen in place, because they don't know, because of the uncertainty, the fog, the miasma that this is placing on the economy. They don't know what to do, how to respond. So they're just sitting on their hands. Now that's going to show up in the economic data pretty soon. And if it doesn't change pretty soon, I think any little thing that comes along is going to push us into recession, thus the 60% probability of recession. It's already having an effect on monetary policy, right? The Federal Reserve point blank has said that it's not going to move on policy until it gets clarity or because of the uncertainty created by economic policy, namely the global trade war. So it's already having a negative economic consequence. Uncertainty is its own has its own dark dynamic, and it doesn't typically, when you're in an uncertain world, it certainly doesn't end well. So hopefully, we get some clarity here pretty soon and figure this out. We de-escalate the trade war, get off that off ramp, and get this economy moving again, because certainly it was in a pretty good spot before all this started.
All right, on that optimistic note, our audience has had their morning shot of informational espresso, so we'll leave it there and tackle the day. Thank you to Mark Zandi, Chief Economist at Moody's Analytics. Mark, thank you so much for swinging by.
Anytime, Jay. Take care now.
And a warm thank you to you, our members, for joining us today. If you want to connect or suggest a topic, reach out to us via the email on the screen or join the conversation on LinkedIn. If you missed an episode, you can see the replay on our website or catch our podcast edition anytime on Apple, Spotify, or wherever you get your podcasts. We also want to draw your attention to the 2025 Global Summit at the U.S. Chamber on April 22nd and 23rd. Entitled Charting the Future, the summit corresponds with the IMF and World Bank meetings in Washington and will include geopolitical discussions with global policy leaders and senior business executives. See our website for more. This has been The Call, brought to you by the Global Intelligence Desk, asking the right questions to navigate uncertain times.